All right, guys, welcome to the debate slash panel about how to monetize Blockspace. We have four awesome panelists. Let's just run through a quick round of introductions. Start with John.
Hey everyone, I'm John. I'm one of the co-founders and partners of DBA, which is a crypto investment fund.
Hello, everyone. My name is Josh. I'm a co-founder, CEO at Supra. Really happy to be here. Really looking forward to this discussion.
Hey, I'm Max. Long time no see, guys. I work at Anza. We develop the core client for Solana.
Hey, Tarun, founder of Gauntlet and also investor Robo Ventures. And yeah, excited to be here.
Sweet. All right, so the goal of today is really to understand how protocols should be thinking about monetizing Blockspace, whether or not Blockspace is effectively a commodity will be trading down towards zero in fees, how to think about MEV, and just broadly the differences in protocol design. So I think just to start off, just want to understand each of your perspectives with regards to how we should be thinking about Blockspace. Is the correct mental model around Blockspace a public good or something that should be charged for with fees from day one? Here's from the blockchain builder's perspective how we should be thinking about Blockspace from day one. John.
I mean, general way to approach it in my mind is that early on, I mean, you treat it like a public good in the sense as far as the monetization point of, I don't think that anyone should be launching a chain, or most of these general purpose chains at least, should be generally launching a chain and trying like aggressively to monetize from day one as their core goal, just for the same reason that any startup that you're talking about is, usually an early stage startup doesn't need to, you're not telling them like, hey, show me profitability on day one. You're really just trying to like, all right, just get a bunch of developers to use the platform. But I think the eventual steady state for all of these types of general purpose platforms, whether it's Ethereum or Solana or whatever else, is you are going to eventually need to have sustainable fee revenue to the validators and to the token holders. Otherwise, there's just not going to be a reason to run the chain and hold the token if you're not getting those excess profits. But I mean, early investors in it certainly should be willing to generally, work on it based on some expectation of future profits.
Yeah, so I think that basically fees should be as cheap as possible for as long as possible and only really increase to force a back off as you approach the execution capacity of the system, whether bandwidth or execution. I think fees should be used as a deterrent for spamming and just making sure the system doesn't buckle. So I think baseline fees for just regular transactions should be as cheap as possible. Of course, I like the idea of localized fee markets. If you're trying to hit the same state, it should get more expensive. But for transactions that are, independent, I think they should be as cheap as possible, and that the base fee itself should be as cheap as possible and only go up once again if you have execution congestion or bandwidth constraints. And then finally, that doesn't, however, preclude my point of view that priority fees, if you want to have transactions land earlier, you should be able to pay for that as well. But for the average user that doesn't need that urgency, it should be as cheap as possible.
I guess I would say blockchains should run with a profit motive. Like the holders of the token are the people who control what happens on the blockchain, and they should be rational agents who act in their own self-interest. And to that end, there's a sweet spot in how much you charge for your block space. You want to charge some so that you make money, but not too much so that apps and users leave and don't want to use your chain. So it's kind of like a Laffer curve is the way I would describe it, where you have some parabola looking thing of the higher you charge your fees, the more money you make up to a point. And after that, it starts to decline, and you kind of want to find that sweet spot in the middle.
Yeah, I would say people love this strained analogy of like every website needs a blockchain, whatever. But one thing about the internet monetization historically is that content was cheap to be created, basically free. But then the economic layer in terms of ads was always routing to only some subset and all the value went to a very small subset, generally speaking. In blockchains, those two are inherently entangled, which means that if you don't have any real actual value, you're never going to be able to create this feedback loop that makes your block space valuable enough to have a positive fee in the long run, like a strictly positive fee. And so I think people there's a little too much of like hoping that there's a, everything needs its own chain, whereas things that need their own chain generally need to have a reason for doing it. So in the cases of Hyperliquid, there's a lot of reasons for them to actually enforce certain covenants in their own chain. But in the case of, I don't know, a social app or consumer app, it's kind of much more dubious that you need that. And so I basically think like if you can't really build a feedback loop, your goal should just be 0 fees. But if you have a feedback loop and you're valuable and people are monetizing off of it, there needs to be some redistribution back to the chain for the infrastructure and for the maintenance of it.
And Tarun, is there a certain threshold or kind of model that you have for when that point happens?
Yeah, so I mean, we've seen so many historical failures in blockchains where like the token never was able to accumulate value. Like the token holders who invested initially in the network never really realized any of the value that the network produced itself. So there's a sense to John's point that every new chain is a venture investment. So like all the block space you're underwriting is not free. It's actually almost like debt. You need to actually kind of use it wisely in the beginning in order to generate real activity before you're able to turn on sort of fees. On the other hand, you sort of need to have a way of turning on fees in a way that's sort of guaranteed, because as you know, yes, protocols have been turning on fee switches as promised 4 or 5 years ago, but it has not gone the way I think the initial token holders expected. And so ways of guaranteeing that value does come back to the token holders eventually, I think is the best compromise you can do. And it becomes a little bit like block space should be thought of as a venture debt investment. That's like sort of how my mental model for if you're willing to do a new chain. So
one of the infamous commentary on Twitter has been that Ethereum should tax the L2s in so much as to say that that Ethereum L1 should charge more for L2s to post their data, to have settlement, all that kind of conversation. There's a lot of pushback against that idea. Some people think that there should be some sort of more of like a mutualistic relationship. Is there a correct way that a protocol should think about taxing or charging value for its users of its block space? And is there a wrong way that protocols should charge for block space? Josh or John?
I mean, I think the main problem, at least at a high level, with the idea of Ethereum trying to increase fees and, tax the L2s in some form to capture more value from them is just the scale that we're talking about here, like, doesn't make any sense. Like, it's not going to be an exciting outcome, even if Ethereum started to charge more fees on the current L2s. Like, it's just not a lot. The only shot that any of I would say any general purpose block space, whether that's Solana that even has execution or something like Celestia, which like doesn't, it's just EA. The only way that you're gonna probably have like very sustainable fees in the long run is if you just have a lot of scale. And Ethereum needs to do that, in my mind, before it can even like reasonably think about trying to hike prices. If you get to like 1 million blobs, and sure, all the rollups are using you and you're doing like a gigabyte per second throughput, do you start to think about a 10% fee increase if you think that you have a moat and your customers won't leave? Sure. But when you're like orders of magnitude away from that, it's just like not a thing that I think that you have the luxury of doing, because the chains will leave like very quickly, and it's not that much money anyway.
Yeah, on that point, if you have 1 million TPS, which has been our kind of marketing goal of where we want to get to eventually, we'll see how long eventually is. But if you do get there and then you charge 0.2 cents for each transaction, then that's $60 billion a year of revenue, which you apply any reasonable multiple to would mean that the Solana protocol is worth at least 5, maybe even 10 times what it is today on a pure like fundamentals driven value investment basis. So that is only possible at a scale that's maybe, I think we're 1400 real TPS today. So we need to get up to much higher scale than we're at right now. But our average transaction fee is higher than 0.2 cents right now. So maybe we're somewhere, there is at least light at the end of the tunnel where if you do get enough scale and you charge cheap enough fees, you can support that with a wide enough user base.
So I think that's a very good direction to move towards. The problem though is to create enough demand for 1 million transactions per second. Like our industry, everything together is like what, less than 20,000, even after this long, isn't it? Something like this, right?
I think much less. I think we're maybe like 80% of real TPS right now at 1400. So that's like, we're maybe 2000 TPS total as an industry right now.
Yeah, even worse. So the thing is, transaction fees, they do become very potentially large or lucrative overall if you have that scale. So you're just going to have to get everything on chain, like everything, like every time you take a step type of situation. It's just not feasible, in my opinion. So if transaction fees are extremely low and you need to have this extreme amount of demand to hit those numbers, which I just don't really know if we'll ever get there in my lifetime, is, you need to capture value some other way. So what are folks doing today? They're trying to monetize through MEV, right? But that affects the user experience, the quality of the execution for the end consumer goes down. It hurts the execution quality. Now, there is good MEV. Do we agree there's good MEV?
No.
What about timely liquidations?
You want to minimize the value that is sucked out for liquidations as much as possible. So if they're making a bunch of money because the best way to get the liquidation is to bribe the validator, that money that they're using to bribe the validator should have been going back into the protocol.
I agree. And also, what about arbitrage? Is that good MEV?
No, that's very bad for spreads on chain.
Doesn't it create tighter spreads?
No, it creates wider spreads.
Okay. I have to look into that one. So I guess the way we look at it as well is you want to have mechanisms where the chain itself, the layer one itself, can capture this value, right? And then redistribute it to where the value came from. I mean, this value is created from the layer one itself or the chain itself. And then these applications, right, the dApps created the value as well. They should be getting a lion's share of this liquidation fee, in my opinion. Now, how do you capture it on a system level? We've been thinking about it very deeply at Supra, and the only way we can think about it is by having what we call system level automation. So we run execution at the end of the block on the system level, which can basically seek out any liquidation opportunities that were not triggered by community, trigger it ourselves, take a flash loan from like our own treasury, fill the position, and this is the kicker, redistribute that value to the dApp and to node operators, and then also keep some for the treasury, which is for the community. So this is what we are aspiring towards.
Why do you do it at the end of the block and not at the beginning of the block?
So we have community auctioned automations at the top of the block. So Oracle data first, and then community auction automation, and anything left after retail transactions go, we'll execute at the end of the block. Now, this is still a design decision we're looking into, but that's kind of currently our point of view. Community goes first.
Yeah, speaking of fee models,
So I think the tax the L2 thing is a very reasonable argument. And the more kind of simplistic way I think you have to think about these things is in L2s, there's one version of the world where you basically you have two principal agent problems. One version of the principal agent problem is the L2 is a principal. It's the sequencer is sort of the one responsible for the capital, and the L1 is the agent. And the agent doesn't really have to do much. They're doing storage, and then once in very, very infrequent amounts of times, they have to validate a fraud proof or a state root, a ZK state root. On the other hand, you could view the L1 as the principal, and the L2 as the agent. The L2 is the agent that's like executing all the transactions. The L1's capital is sort of being lent to them via the bridge. And if you think about it that way, those two problems are very asymmetric. In one case, the agent is making all the money. In the other case, the principal is making all the money. that can't be a very sustainable equilibrium, right? And I think like when you think about it that way, there has to be some value transfer eventually, or the L2 should just go run their own L1, right? Like there's not really that much. There's not that much of a benefit a lot of them are getting. Now, the ones that have really valuable state, like the bases of the world, that's a very different story, right? Like that is, they actually really do need the protection. But like 98% of L2s are clearly like, it doesn't really make, it's not a fair trade in some sense. And I don't think you can enforce these things post hoc fundamentally, like to John's point. Like it's not like Ethereum could go back in time to 2017 and be like, we're going to put an L2 tax. But it is sort of the thing when you're designing a new protocol, you need to think of ahead of time. Because otherwise, obviously, there's tons of ways value will leak out of the system.
And I guess the demonstration of this is the fact that OP is charging base 10% of their revenue right now, which is a tax on the L2, but it's just not Ethereum doing it. It's like Ethereum getting cucked by OP, who's actually the one charging the tax. So why is that tax not going to Ethereum? Like, what is OP doing for base in the last 2 years? That's the same exact software for the last 2 years, but they're still paying 10% rent to OP.
John, do you have anything on Tarun's point?
I mean, on the last point, I mean, if I had to take a bet, I would just bet that they're not going to continue paying that 10 or 15% or whatever they're paying, because I don't think that they're getting sufficient value from anyone. And I mean, my gut is that's the same for most rollups with their relationship to Ethereum too. It's like they wouldn't be willing to pay a meaningful tax. Like there just isn't the pricing power there.
Yeah.
Actually, related question, which is, do you think the terminal value of bridges and L2s is the same or not? Because like that kind of is
The terminal value of bridges
like,
and L2s?
yeah, the terminal market value of bridges, which pay some nominal fees to Ethereum, but not that much, and L2s, which also pay some nominal fees. Do they, in like 5 years, converge to the same? You know,
Terminal value in terms of what they pay to Ethereum, not what they're worth.
Yes. Yeah. No.
Probably. Yeah, they probably try and closer at least.
So
Yeah.
Solana might be generating as much revenue for Ethereum as an L2 or Hyperliquid indirectly, right? So I think that's something you have to think about when you think about these systems.
Is there a fee model which you guys have found to be the most either democratic, productive, or efficient, or all three? Whether it be Solana's model with Jito tips and priority fees, Ethereum's model post EIP 1559, perhaps even Max. I mean, do you think Solana's model is way more crisp than Ethereum's?
No, like our model currently is more scuffed than Ethereum because we have the very weird interaction between Jito tips and block rewards. And then, yeah, I would say our model is currently very scuffed. And I would like us to move to a much more simple model where people pay for inclusion and not for the right to trade. And you pay for the right to interact with the blockchain, not for what you're doing on the blockchain. And I think if we continue to tax apps at the rate we are taxing them, I've been talking to a bunch of apps, they don't like it and they want to leave. And there's a great filter for every blockchain, which is at some point you get to the point where apps they have their own user base, they have their own front end, and they turn to you and they say, you're taxing me way too much with your MEV. And Ethereum basically, this will be looked at in 10 years as when Ethereum died, is when they failed to solve this issue. And L2s were their solution, but it was like, in effect, killing the protocol to do these L2s. And so this is our great challenge right now at Solana, is how do we lower the tax rate in terms of MEV, hopefully effectively to zero, and then only charge for transactions. And then we will charge for a lot more transactions than we're doing today because we will attract apps from all over, and existing apps will not leave. And so if we do not do something, I expect that apps will leave if we continue with the same fee model. Maybe not today, maybe not in 2 years, but on a 5-year timeline, we cannot continue to charge fees the way that we're charging them.
Josh, do you have any thoughts on the fee markets of Solana, Ethereum, or Supra, just as regards to the most efficient or optimal designs?
Yeah, so I think, once again, base fees should be as cheap as possible unless the system's getting congested. but you can't build a business on that, right? There's no business model. It's, you just have extreme throughput, and the fees should be minuscule as a result, right? So, I mean, at the current thinking for us is that I think priority fees for priority execution matters. I think if people have an opportunity that is worth $10, they might be willing to pay up to $9 for that. But that's for very hot spot, congested, high value opportunities. I think it'd be worth talking about what Chainlink, Aave, and Flashbots are doing recently. I believe, I hope I don't butcher this, but Chainlink price feeds triggers like a liquidation, right? And then Aave is the platform where this lending protocol is happening, where where the activity is happening. Of course, the layer one is actually executing, but I think they're working with Flashbots to create bundles that include to basically backrun the Oracle update to have Aave or someone or basically themselves or Aave trigger that, collect that reward, and redistribute that value to Aave and Chainlink. The thing with that is that it still doesn't manage to handle. I mean, that's good for Aave and Chainlink, but it doesn't necessarily mean that that bundle doesn't contain toxic MEV. In fact, it might be maximally extracted so that they can afford to tip or bribe or whatever, give value to the block producer. The higher it is, the more likely that it'll be included. So what happens here is that I think you still end up with toxic MEV in that model. But what you can see is that these applications are desiring to capture this MEV. Now, especially from what I can tell, things like liquidations as well as arbitrage, I don't know if they're capturing that value, but if the system itself could capture it, opportunities that were not triggered on time, if we could capture it in real time at the end of every block and redistribute the value, becoming a new revenue stream, transparent, deterministic revenue stream, crediting the right actors, the stakeholders, the DApp where the opportunity came from, removing toxic MEV. I can talk about that a bit later. Of course, I'm just saying mitigation. I'm not saying we have a perfect solution there either. But suppose we could mitigate toxic MEV, capture the quote unquote good MEV, redistribute that value to the DApp, to the node operators, replacing what they'd otherwise have from toxic MEV, and also have the network itself have a treasury, which is network owned, governance controlled, that can do things like buybacks, perhaps, which means that all token holders, the rest of the stakeholders could benefit. I think that's probably the recipe for the healthiest design you can have. The problem with blockchains today is they don't have this value capture. And the thing that enables it on Supra, this is a work in progress, but we're shipping automation basically right now. The node operators are in the middle of updating this. You need to have, as far as I can tell, system level automation to capture that value and then redistribute it. Otherwise, you have to depend on external actors submitting transactions on chain. So we hope that this unlocks a lot of value and also keeps the value within the ecosystem instead of to 1,000 very sophisticated MEV connoisseurs. Our communities are tens of millions of people, but maybe 1,000, I don't know, folks are actually getting all that MEV value, right? It's not healthy. It's extracting too much value from these chains.
Coming back to the fee models with regards to the specific types, Tarun, I'm curious, in any of your research in math and in just generally analyzing block space, have you came to a consensus as to what type of auction or fee model, whether it be flat fees, hybrid, auction models, are the best for high throughput chains to maximize sustainability and fairness?
Yeah, so I guess like there's a couple of questions here, which is like, how much do you care about the applications being able to generate revenue that's sustainable versus how much do you care about the base network? And in some ways, a base network always needs the applications to first be able to generate revenue before it can really take any revenue. And one important thing about that is it needs to also, there's two kind of trade-offs. One trade-off is we actually want to kind of decongest the markets as much as possible. So local fee models, multi-dimensional pricing, all of these types of things to add more complexity to the system, generally speaking, allow you to say, okay, only this part should be increasing really quickly, the rest of the network shouldn't. The problem with those is they also increase complexity. So like application developers, if you make the fee model too complicated, will actually have trouble figuring out how to optimize the fees for their users. So you have to walk this kind of tightrope of, we have a bunch of resources that we're selling, like block space, meaning the actual physical execution, the actual bandwidth being used, relays, whatever, ZK, if that is a cost for you. But we also need to make sure that it's not so annoyingly complicated that the particular fee model you chose actually changes what applications are cost effective to build. So like an example of this is something like a lending protocol. Imagine that it costs you a lot more to take an Oracle update than say Ethereum or Solana. Mainly, let's say it's like the protocol forces you to use a ZK Oracle, where the Oracle is run by the main L1 validator. So the reason I bring this up is Hyperliquid is a great example of this. The main Oracle that's used is run by the validators, and it's sort of a public service by the validators, but it's also this thing where it's always the first transaction in the block. And you could imagine that you have an L1 that's actually trying to charge you for preferential usage of that Oracle, but it's because it has to be done in ZK, they're charging you 100 times more than everywhere else. Well, now that restricts the types of applications you use. You might actually make your lending protocol a lot more risk averse, because you actually don't want to call the Oracle as much because it's too expensive. So there's a lot of stuff that these are all kind of like boring practical things, but they actually do change the nature of these protocols based on how often you adjust prices and how complicated you split things up. And so I think everyone has sort of different views on that. I think, Hyperliquid versus Solana versus Ethereum is kind of the general spectrum I look at, where Hyperliquid Core does a lot, where there's tons of preferential access to like Oracle updates, cancels, whatever. Like the validators kind of guarantee you that, but you're sort of implicitly, trading away trust from them. You're giving away fees to them from the application layer. In the Solana case, it's a little more complicated, and maybe Max can talk about that. And then Ethereum case, Ethereum just gives away most of the resources for as cheap as possible, right? And those are three very different philosophies. Where Hyperliquid is offering you services, but charging you a lot in the sense that the token holders take a lot of the fees via the exchange. Solana, somewhere in the middle, and then Ethereum give everything away for free.
I mean, the one thing that Ethereum isn't giving away for free is the one thing that's the most important, which is priority access to state for things like oracles and things like cancellations, etc., that everybody wants to prioritize. So I guess I would say they're kind of giving away all of the basic resources for free, partly because they have almost no activity, and that's the way the controller works. Is it just kind of goes based on how much activity they have. But then they've done almost nothing to optimize for the tax rate on time-sensitive actions. And in some ways, that's killed a lot of the DeFi activity there because it's so extractive. So you really, again, I just want to emphasize that you have to choose somewhere that is not too high to push the apps off of the chain. And I think we're at danger levels right now in Solana of getting to a point where apps are looking at how much they're bringing in and how much we're taking, and it's starting to become uncomfortable for them. And so you want to be sustainable long term, you need to make it so that apps want to come build, because the benefits of building on Solana are we give you users, we give you technology, you don't have to build your own transaction landing stack, which turns out to be super hard. And all you have to worry about is making the best app possible. Well, if we then go and charge an Apple style 30% rake on all of your revenue, then all of a sudden other places start to become a lot more attractive that aren't charging that rake. And so my kind of overarching goal over the next few years is to steer us to a place where apps can control a little bit more about their own ordering, and validators have less ability to do extractive raking things that make apps not want to build on the chain. Because ultimately, like, even though this sounds like you're taking control away from validators, it's like, would you rather be a validator with slightly less control on a chain that has way, way, way more activity in apps? Or would you rather be like a validator with more control on a chain like Ethereum that has almost no activity and nobody's building new apps on it?
Yeah, so to Tarun's point, in Hyperliquid, they've kind of vertically integrated layer 1 with Oracle, and they've prioritized Oracle. Is that right? We also do that. So we have our thesis is full vertical integration. Layer 1 with Oracle, with cross-chain communication, with automation, single stack, shared security. And since we have control over the block structure, right, we can design this. We also see it's important that the Oracle data has priority access to land, and we don't charge for this. So the problem with DeFi is that during congestion, especially for Oracle updates, those don't necessarily land. You might have to really increase your fee for it to be included, which can be minutes, or it can be a while sometimes before the Oracle updates on some of these chains, right? And so we think it's really important to prioritize that. Max, what you're saying though, with applications controlling the ordering of the transactions, would that mean that they would submit a bundle or a batch to the layer 1?
So there's a few ways to do it. One of them is you kind of let them delay their own transactions. So we have these write and read account lists. And so you could look at the write and read account lists. And if one of your accounts, your program is in there, you get to execute some special logic that tells you to delay some transactions more than others. And so something like that immediately unlocks Hyperliquid style scheduling, where cancels can come in and get a 20 millisecond speed bump or whatever. So that's something that we're looking at. We're also looking at, in the scheduler, we have prioritization by priority fee per CU. And so if you play around with how many CU the transaction takes, that changes the denominator, and that changes how much priority you have in the scheduler. So that's another option. And then the final option, which is what I'm suggesting for when we move to multiple leaders, the way we merge the blocks is that we'll order everything by the priority fee. And then the apps will read the priority fee and execute logic based on that. So if they don't want a certain type of transaction high up in the priority space, they can just say, I'll read the priority fee, and if you're a take transaction and you're high in the priority space, I'll fail you. And what that does is just automatically forces the takes to be at the bottom of the block, if that's what you want. And you can do a lot more flexible things with that too, but that's just the most kind of basic crystallized example of what you can do with priority ordering.
John, I have a question for you about L2s. Kind of as Max has alluded to, the way that apps on Solana want more, let's call it sovereignty, more application-specific sequencing type of properties. L2s, most of them have a first come, first serve sequencer model. I'm curious if you see this as a long-term solution to L2 ordering for blocks, and if not, or if so, why?
Definitely not. I don't think there's going to be any difference between L1s and L2s in terms of like what they need. They're the same thing. I mean, saying an L2 needs a different thing than Hyperliquid is just like, it's just kind of a nonsensical comparison in my mind. Like, they're competing for the same exact application and the same exact users. The users don't care if they call it an L1 or an L2. If the way that Hyperliquid's ordering rule works better, where, hey, we prioritize cancels, if that's better for that application, then that's what the L2s should do too. So I think that everyone's going to be competing on the same dimensions, no matter what you call yourself, an L1 or an L2. And figuring out these ordering rules is going to be one of the really big challenges for platforms like Solana. In practice, the difference between L2s and L1s, I would say in broad brushstrokes, is that most of the L2s have a just at least easier problem to solve, in that in practice they're pretty much all centralized. It's a lot easier to solve the problem when you're centralized and you can just say, hey, I'm going to order it this way, like, trust me, bro. It's really hard to do that when you have a decentralized validator set, which is where, I mean, like things like MCP and priority ordering and forced rules that you have, that could be a potential solution, because otherwise I agree with Max that I think that is like one of the largest existential problems for Solana right now, is if it can't find a way to reduce its margins, successful applications will leave. You know, if Pump Fund is looking, saying, hey, I'm generating, $2 billion a year, but I only keep $1 billion a year, and $1 billion goes to Solana, at some point you run the math and say, I'm going to leave and go make my own chain so I can make $2 billion a year instead. That math breaks at like some point. The margins are probably, 50, I don't know exactly what the number is today for different applications, but like it's rather high, the amount of value that a lot of successful applications are leaking to chains like Solana today. And so figuring out, what is that margin in the long run? Is it 5%? Is it 10%? Is it 3%? Is it 15%? I don't know. And really all of these general purpose platforms are trying to provide some service for which they can obviously charge for. And then just depending on the strength of that service, you might be able to charge a higher margin. Like, I mean, the simple, clear example is like, if you imagine like, what is the long run margin that Pump Fund is willing to pay to Solana? If you say maybe it's 10%, maybe that's the right number. I don't know exactly what the number is, but like let's say that whatever they're charging was too much and they decided to leave and they wanted to make like a roll up or whatever, and they were going to be on Celestia or EigenDA or whatever. Whatever margin they're willing to pay them, I'm sure would be lower than whatever they were willing to pay Solana. Maybe it's 2%, maybe it's 1%. I don't know exactly what that number is, because just in general, they're providing generally a weaker, more replaceable service, where Solana obviously has I would say, stronger service in that like all of these chains, I mean, they're really competing on does the infrastructure work and then the interoperability and kind of the network effects of them. The best interoperability is just sticking everything on one chain, because then everyone has the same standards and the same interoperability. It's really easy to use. And so just seeing where those long run margins end up, I don't think anyone knows really what is the right number, but it's definitely a lot lower than what it is today. So you're going to need to just make up on that with huge scale.
And as a corollary to your observation, basically, where is the sustainable mark? Somewhere between the next best option, what they're willing to pay them, and what they're willing to pay us. Anywhere in that range is sustainable. We'd like it to be on the higher end of that range, obviously. But if it's over that mark, then obviously we're going to start to bleed out apps. And so if you have no control over it, that's the worst place to be, because you don't get to play around with it at all. And so we definitely need to at least make a lever into the protocol that we can start to reduce it, because it's clearly getting to be too high right now.
So back to first come first serve question on layer 2s. As you mentioned, it works because it's centralized, one place. You just have to trust it, you know? The problem with a network of nodes are that data arrives to different nodes at a different period, different time, different latencies. So you can't have exactly a view of the answer unless you do some sort of like another round of consensus on the ordering, some sort of, basically add a bunch of latency. So if you want to have low latency, super fast transactions in a decentralized network, you cannot do first come, first serve and prove it. It's just not provable, meaning you receive this information 10 milliseconds after I did, you know? So I'd say I just didn't see it, so I didn't include it, you know? So any ordering rules have to be deterministic. Now, what's interesting about that, I think Solana is looking towards execution based off a priority fee, which is a deterministic rule, right? Super is actually looking into randomized execution, so unpredictable ordering for just the regular transactions. We have on-chain VRF through a threshold cryptography, and we think that this is interesting for partial MEV mitigation on that toxic MEV, randomized execution in that block. So it's just something to mention that the rules have to be deterministic for sure. I actually think Solana's direction with priority or execution based off of priority fees is deterministic and is a good step forward. But yeah, I mean, first come first serve just won't work on layer 1s.
All right, guys, just last one, yes or no, quick answer. Is it healthy that block space fees are trending to zero over time?
I think it's healthy provided the variance is very large and there's somewhere where it's not zero, right? Just because the mean fee across all networks, indexed by network, not by volume, is zero, doesn't mean like the outliers aren't where all the real activity is happening.
Yeah, I guess I would say I would agree with Tarun, and I would say I don't know if it's the case that fees are tending to zero. If you look at across the ecosystem at blockchain revenues, they're up, right, overall since DeFi summer. So even though the per transaction cost is down, the total aggregate of multiplying those two is up.
I think the base fees trend towards zero will never be zero. You need them, and they have to be there to protect the blockchain from being run over by too many transaction spam, execution capacity limits. So they have to be there. But I think that's just like baseline, right? But I think the real revenue will be from paying for priority execution. whether that's an automated transaction that you want to be the first to execute that opportunity, or just paying higher for, ranking in the execution priority. I think those will be very large. They should correlate with the value generated from the system. But the base fee for the everyday user that's not interested in that particular use case, they shouldn't pay anything almost. It should be virtually free, it should be sub-penny.
Yeah, definitely the average fee per transaction, I would say, will tend towards zero and not actually hit zero. Is I think the trend that we'll literally see, and that means those margins that I was describing before. I think those will compress on both the base fee side, the take rates that you're taking out of MEV for all these base platforms. I think all of those margins will go down. I think if you want to chart the base layer general purpose infrastructure, the fees and REV that they're getting versus what the applications are going to get, that is going to be a straight line down. I think that you look forward in 5-10 years, where's 95% of the value going? It's going to the application, certainly. Probably not even that long. But on a still just total scale, I think that the numbers for these general purpose platforms, the very successful ones like Solana, if they're the place in several years from now, that just baseline number is still going to be very large. It's just that the margins they definitely have to come down from where they are today.
Thank you, guys. Let's give it up for our amazing panelists, guys. Thank you.